Today I answer 7 questions of our viewers. So if you have a question you'd like to ask, leave a comment below. Otherwise, let's begin. And we start off with Olivia. And she asks, how can I qualify for a joint home loan if my partner has bad credit? Well, there's a few ways you can qualify. Firstly, one of the things you want to do is look at a credit repair process. There's a lot of credit repair agencies out there that will be able to potentially repair your partner's credit file, and that'll allow you to go to the mainstream lenders. The other ways to get your partner a part of the application would be potentially your partner going as a guarantor. Guarantors essentially allow you to own the property but not necessarily be a part of the loan. So you'll have to be careful of that one because you might find that the serviceability won't pass because guarantors can only be security guarantors, meaning allowing you to take the equity available in the property. No longer do the banks offer what's called a servicing guarantor, where you can use their income, but them not necessarily being a part of the application. So be mindful there. Other ways is to use non-conforming lenders. Non-conforming lenders are lenders that do things that others don't. So whilst you might not fit in the mainstream, so your major banks and your second tier banks, whilst your partner might not meet their criteria, you might find that a non-conforming lender might charge you a higher interest rate, but will be well and truly within their scope and will be able to get your partner a part of the application. So there's a few ways there that might help you there, Olivia. The next question is from William, and he asks, are fixed rates or variable rates cheaper? And it really depends. We see in cycles where the variable rate can be cheaper than the fixed rate and vice versa. So really depends. And what I would encourage you to do more so is not look at the difference in whether fixed rates or a variable rate is higher or lower. More importantly, look at the features of each and find out which is better for you. So a fixed rate is really good if you're looking to budget and having stability. But the trouble is that sometimes you're limited to the additional repayments you can make on top of the minimum. So if that's the case, you're looking to pay off the mortgage very quickly and expedite repayments, then a fixed rate might not be a smart option. Variable, on the other hand, will allow you to smash off the mortgage as quickly as you like, but just be mindful that the rates can go up and down. So really look at the actual features of each and then make a decision, not based on rate, but based on what you think is more appropriate to you. So thanks for your question there, William. The next one is from Lucas, and his question is the lowest home loan rate always the cheapest? And no, it's not, because some of the things that you've got to be mindful of, particularly with honeymoon offers, is that over the life of the loan, it may not be the cheapest. A honeymoon rate, for example, is very cheap for 1 or 2 years and then reverts to a higher interest rate. You might get caught out thinking that you're on a low rate for those first couple of years. And a lot of the lenders, what they're trying to do is get you comfortable. Once you're there for 1 or 2 years, you've got all your banking set up, they know you're less likely to move. And that's where they really make their money, where you stay lethargic and not looking to shop around. And from generally years 2 onwards, generally we see 3, 4, and 5. So if you've been with a lender too long, that you can find that they become less competitive. So I think the short answer to your question is the lowest home loan rate always the cheapest? Well, in the long term, not necessarily. In the short term, the things to keep in mind are the interest rates and also the fees and charges. So short term, sure, the lowest rate might be the cheapest. The next question is from Isabel, and she asks, how do I determine the value of my property? Well, there's no science. And the trouble is that you might get a real estate agent in and they'll tell you exactly what your property's worth if you were to sell today, but that'll be completely different to what the bank will consider the value of your home is. So unfortunately, there's no easy answer of saying what the value of your home is, because the bank thinks your home is worth versus what a real estate thinks your home is worth. If you want to determine what the value is in way of lender, the best thing to do is look for previous sales in the area that are within generally a 5-kilometer radius that are comparable to yours. So the same number of bedrooms, the same number of bathrooms, the same land size. And if you compare between 3 and 4 different properties that are comparable to yours, that's essentially what you can determine the value of your home is. The next question is from Harper, and he asks, how do you calculate how much you'll save when you refinance to a lower rate? And the quick and dirty way of doing this is simply taking the rate you're on, say you're on 3%, versus the interest rate you're given, say 2%, minus the 2. In this case, it's 1%. And then multiply that by your loan amount. So if you've got a $500,000 loan amount, 1% would be $5,000 a year. It's very rough, but it gives you a quick idea on how much you'll save over the next couple of years. And if you're wanting to do something more complicated than that, then there's a lot of tools online, but I'd say keep it simple, get a quick gauge on what you'll save over the next year or two, and that'll give you an indication whether it's beneficial to be refinancing or relooking at your options. So thanks for your question there. Now we've got Theodore, and he's asking, what is an appraisal versus a valuation? An appraisal is something a real estate agent will give you, and they're appraising the value of your property as to what you'll be able to sell for in this market. A valuation is a bank-determined valuation, determining exactly what they're willing to lend against. That valuation is what they deem the value of the property is worth. And for them, they're really looking at a conservative view. So if they were to take over the property, how quickly could they sell it and at what price? So they're not looking to get the highest value like an appraisal. That's what the real estate's looking for. The real estate's looking for the highest possible. The real estate agent's really telling you what he or she could get if they marketed the property, the absolute best case scenario. And final questions from Henry, and he asks, will I have to pay lender's mortgage insurance twice if I refinance? And absolutely you will. The only way you get around this is if you stay with your current lender. Some lenders will actually give you a discount based on the insurance you've already paid. So instead of having to pay another, say, $10,000 if you were to refinance to a different lender, the bank can consider how much you've already paid, say it was $9,000, and charge you the difference. It's a bit of a mug's game, if I'm honest. There's a few major insurers in Australia, and let's say you're with insurer A, with Bank A, and you go to Bank B, that's with the same insurer. Unfortunately, you can't transfer the policy over, so you pay the mortgage insurance again. So be careful of that. If you are looking to refinance, it's something you'll want to avoid because it can ruin the value and any benefits in refinancing. And here at Hunter Galloway, we get home loans approved. So if you live in Australia and looking for a great mortgage broker we can help, visit us online at huntergalloway.com.au or reach out and call us on 1300 088 065. We help Australia-wide and don't charge a fee for our service. So we'd love to help. Reach out and hit us up. But until next time, I'll catch you then.